What I want to discuss in today's video is using a whole life insurance policy to finance opportunities. Why would I do this? Specifically, why would I take out a whole life insurance policy, build up the cash value, and then when an opportunity comes around, let's pretend it's a real estate opportunity or I'm investing in a business, whatever it might be, I'm going to borrow against the cash value in my whole life insurance policy to take advantage of that opportunity. Why would I do that? This question comes up quite a bit. It often comes up from individuals who are taking advantage of opportunities, A, with cash, or B, they're financing opportunities through a lender, through a bank. So what we're going to do first is discuss these three items, using cash, using a bank, and then using a policy. And then we'll look at a specific example of a policy. We'll go through it step by step of what to look at first with respect to the growth, then the policy loan, and then we'll hit on what questions you should be asking or what questions I would want to ask if I'm new to this and trying to find out if a whole life insurance policy makes sense if I plan on using it as a financing tool. So let's first look at the most common strategy, which is using cash, money in the bank. So if I've got money in the bank, I can easily spend it. It's accessible. I can use it the same day. This is what most people are used to. Now, if I'm using it for an opportunity, the typical strategy is to use it for the opportunity, but then refill my bank account with the returns from the opportunity. So if I've got $1 million in cash, I see an opportunity where I need $500,000 of capital, I write a check for $500,000, and then as that opportunity produces a return, I refill my bank account up to the number that I like to keep that balance at. That's typically what we see most people do. We all have that number. I like to have X amount of dollars in cash to be able to take advantage of opportunities, or it's just a number that I've always used and I feel comfortable with. Whatever it might be, everybody's got a different number, depends on your needs and such. Now, another benefit to using cash is it's very easy. It's what most of us do because we're used to that. It is so convenient, especially when we start looking at a bank loan or a policy. We add layers of complexity here. There's a learning curve, and that right there can often prevent one from considering a policy, even if it's beneficial there. So we do have to put the time in. Now, some drawbacks to using cash. The returns are typically low. Now, in the past several months, or really the past year, we've seen interest rates go up, and interest rates on checking, savings accounts, money markets, CDs have gone up a bit. But historically, what we have seen with respect to money in checkings and savings in a bank, it is relatively low compared to what I can get elsewhere. And usually if I'm putting money in a bank account, it's not for the returns. Again, it's for the convenience, so I can easily access that cash to take advantage of other opportunities. And then some have discomfort with large amounts or a large balance in their account for a number of reasons. There's been a lot of concern about that over the past year or so. Another thing here, when I take money from my account, if I am earning a return, while it might be low, say it's 3 or 4%, if I'm earning 4% and I take money out, what happens? If you've got $1 million in cash, you pull out $500,000, there's $500,000 left, will you earn that 3 or 4% on? Whatever is remaining, the $500,000. So I do have a lost opportunity cost there. Over the past several years, that's been almost a moot point. No point to discuss that because a lot of bank accounts have done 0% or have had very low returns. Next, use a bank. So specifically, financing an opportunity. I need $500,000 of capital instead of using cash because I don't want to, or perhaps I don't have it on hand. I can stay liquid here, put a minimal amount of cash down, and get a loan from a bank. Now what I have to do here is pay interest to the bank. Now this strategy has worked extremely well for a lot of people because what it allows is for them to remain liquid. Yes, they pay interest, but if I'm able to finance an opportunity from a bank, and that opportunity is going to yield me 12%, or maybe it's my business, so it's much more than that. I can't even put a return on that, but I know it's going to pay me 10x. If I've got to pay 3%, even if it's 10%, if it's a high rate to a bank, I'm okay with it because I know I can do much more with that. So this is where financing often makes sense. I can get access to money or capital that I don't have. So we've seen a lot of people do well there. And then using a policy. So using a policy, here's often the point of attraction. The money continues to compound. What that means is if I've got money in cash value, say it's $1 million, I loan $500,000, half of the available equity. I continue to receive compound interest on the full $1 million. The insurance company still pays me dividends on the total balance, even though I've taken a loan against the policy. We'll look at an example on that in a little bit. If I repay that loan, what I'll see is that my cash value and death benefit is restored to what it would have been as if I never took a loan in the first place. No lost opportunity cost. It's a lot like real estate. If I've got a piece of property that's appreciating at 5% every single year, if I borrow against it, the loan that I take does not negatively impact the fair market value, the appreciation of the fair market value of that real estate. Very, very similar with life insurance. Again, we'll see an example soon. Now, some drawbacks here or concerns people express. Well, I have to pay interest like I would with a bank, but I'm paying it to the insurance company. Also, I need to build the cash value. It takes time. We talk about policy design quite a bit. You can design a policy for maximum cash value with minimum insurance expenses, minimum premiums. Still, in the first year, you'll have somewhere between 80 and 90% of what you paid in available cash value. For example, if you pay $10,000 and the cash value is $9,000 in the first year, yes, it's beefed up for strong early cash value. It's not a zero, but it's still a $1,000 hit. So the early years will be negative, and it's going to take a little bit of time to build the cash value. Typically, somewhere between 3 to 5 or 3 to 6 years at the longest is when I should see positive cash value, meaning the total cash value is greater than my total payments. So let's look at an example of using a policy. Here we go. Step number 1, what I always like to look at first is growth. Meaning before we look at using your policy, putting it in action, what does it look like if you just pump money into it and let it sit and grow? This way, when you take loans or look at loan illustrations, you can see the impact that that loan had in your policy. You can see the two side by side. Here's what it looks like if I don't touch it. Here's what it looks like if I borrow and then repay or don't repay. But with growth, we're going to look at an example. We're going to look at an actual policy, someone that we're working with, but he's got cash value of $1 million. The net growth rate will fall somewhere between 4 to 5%. If he just sits back and lets it grow, we'll pretend the cash value in 10 years is worth $2 million. Step 2, the opportunity. So up here, he's got an opportunity available. He needs $500,000 of capital. What he can do is take a $500,000 loan from his policy. He has a cost to borrow. The current loan interest rate is 5%. That goes to the insurance company. Now, he can take advantage of that opportunity, which he can produce a 12% return or whatever return he knows or feels he can earn, because this is really where he's going to make his money, the opportunity, because that's his business. This is where he has control of the situation. The policy loan. So step 1 and 3 is really what we're going to look at here when we compare the numbers. So the policy loan. Pre-loan, I've got $1 million in cash value, net growth rate, 4 to 5%. Policy loan, $500,000, 5% paid to the insurance company. We'll assume we repay it over 10 years. In the 10th year, when that loan is repaid, the cash value is $2 million, which is identical to what it would be if I didn't touch it in the first place. So this right here is what people like, knowing that I can finance an opportunity. If the money's in the policy, it keeps moving forward for me. And if I pay it back at any point in time, it doesn't have to be 10 years, it could be 5 years, it could be 50 years, it doesn't matter. If I pay it back, I see my value restored along with the compounding that I've received over time. That is the area of attraction right there. Okay, I can pay it back at my pace and I've got everything back. I like that because now I've got this big bucket of value, cash value, that keeps on compounding. Now, Here's the thing. What should I be asking? Where do people have regret or any type of buyer's remorse here? And we'll typically see these questions come up. I've seen them personally over the years with people looking at policies where they are funding, this is how much they're paying in on an annual basis, at least $100,000. A lot of times if it's $500 or $1 million per year, this is where these questions come up. A lot of times with real estate investors, they want to see what am I earning, meaning what am I getting from the insurance company, compared to what am I paying. From a policy standpoint, what is the cash value growth compared to the cost of the loan interest? This way I can see year by year and also the total amount over time, exactly what I got from the insurance company compared to exactly what I paid them. And am I in the black or am I in the red? So let's look at an actual policy here. This policy is 2 years old. He may have actually just made his third year payment, but the values, years 1 and 2, are what actually happened. So on the left, we've got his policy values here. Annual outlay, $250,000 per year. His plan was to get a total of $1 million in, and he might continue to pay afterwards, but the original plan was just to fund a total of $1 million. He liked that because it was money that he had in excess cash. He wanted to move it into a policy. So first 2 years, he's paid in $500,000. Cash value in year 2, about $460,000. The drawback right there. When people ask what is the drawback about the whole life insurance product, even when it's designed, this policy is designed with a minimum premium, maximum cash value, paying $250,000, first year, $30,000 hit, paid in $250,000, I had $220,000 available. Yes, I have a healthy death benefit, but still I take a hit on my money. Second year, paid in a total of $500,000, I've got about a $40,000 loss there. Now, as I look at this, we mentioned somewhere between years 3 and 6 is when it should break even. Here you go. Between years 4 and 5. At year 5, I'm positive. And the policy is performing almost exactly as originally illustrated thus far, slightly ahead actually. So, as we look at this guy, we've got the annual internal rate of return. It's high down here. For a period of time, this is an older 10-pay product, which actually had a nice kick up on the internal rate of return when we exercised reduced paid up. I know that's a technical term, but anyway, there's the annual growth rate. But what we're going to look at is the policy in action. So what did he want to see here? Capital needed of how much? $500,000. So when we look at the $500,000 loan, it's down here, which is after the funding, which will make this example very easy. Let's take a look. So we'll take a $1 million loan here. Let's make that a little bit bigger. Not enough zeros. And the present cost to borrow, the present loan interest rate is 5%. And he'll be locked into that 5% for at least another year. So he's starting year 3 now. He'll be locked into it through year 4. But let's assume rates go up a bit because it is variable. And I'm just going to make it 6% for this case. So now we can look at it more conservatively. Here we go. So if it's 6% when he takes this 1 million, we'll assume this is right now. 1 million, that was the cash value. He borrowed 1 million. Has a little bit of equity remaining, but close to the maximum loan. 6% of 1 million is how much? Over here in column T, annual interest payment. This is going to show how much you are paying in interest every year. So going back to the fourth point, which is what should I be asking? Here's what people want to know. What am I earning year by year compared to what am I paying? What do you see there? What you're earning is less than what you're paying. And the reason why is because we have a $1 million loan outstanding at 6%, that's $60,000. You've got $1 million in cash value, but the internal rate of return in year 5 is 3.64%. It takes some time for a policy really to ramp up in performance. Now, This is an effective tax-free internal rate of return, provided we don't mess it up, and there's something to be said about that. But still, just looking at the numbers, I'm in the red. If I pay interest only, how long does it take? That's just about year 8 there, where I see the growth exceed the annual interest payment. So this guy will show you year by year what you're getting, and this guy will show you year by year what you're paying. Let's circle next to, in light blue, you've got the total gain on cash value compared to the total interest payments. So this will tally up all of your interest payments. So this way you can see over time, what's the total gain compared to the total interest paid. All right, so here it takes between years 13 and 14. And that's if you pay interest only. What happens if you begin to pay it back? So here, he's not paying anything after year 4. He can, but he might say, you know what? I've funded it at the level I wanted to. I'm cash flowing. Instead of continuing to fund the policy, I'll service the loan. Maybe I'll do both, but let's pretend he just services the loan here. And he's paying $60K in interest, so let's assume he pays it back in 10 years. Like the example we had earlier. There we go. So the cash value by year 10, because we're looking at year 5 at 1 million, not paying anything in. 10 years later, you're at 1.7, so not quite 2 million. I just used that for a round number on the whiteboard. But here's the thing, we've got this policy value over here. You're compounding on everything. And when the loan is paid back, what happens, this column in yellow is your available equity. It's restored to what it would have been as if you never touched it in the first place. The cost to you, or to him in this example, there's 2 things. 1, there was interest that went to the insurance company, but then 2, when you took that $1 million loan, what happened to your death benefit? Dropped dollar for dollar by the amount you loaned. And this is a loan workbook that we use for cash value collateral loans, but if we ran this in the illustration software, you would see very, very similar results. The illustration software has a 5% loan rate right now, so you pay a little bit less in loan interest because that's his actual loan interest rate. But here, as we repay it, what happens? If you're going to chip away at the principal balance, what do you notice? What happens when you pay it down? Well, you're going to pay less interest, and you have an earlier point in time in which your gains are exceeding the interest you're paying. The same is true over here. But this is the kind of stuff I've seen a lot of people that like numbers, or they're using this for real estate and such. They want to know, how do I put myself in the black earlier so I don't have a negative impact on my policy? And typically when it hurts, like when I've got to look at the numbers like this, where I'm taking large loans, is in the early years. Once you get moving after the 10th policy year, you're in a position where the policy is just cranking. So we don't have to worry about it as much. We still want to look at the numbers, but look at the IRR after year 10 compared to before year 10. That's what we've got to look at. Anyway, I hope you enjoyed this video. I do hope that it helped with respect to why people use a whole life insurance policy and often what we're comparing first. We do have a video that directly compares using a whole life insurance policy compared to using cash, because a lot of people are used to doing that and they've had a lot of success. So we go over the pros and cons of both. You'll see it up in the link above. It's a 2-part video. We've got part 1 above, but you might like that video if you really like to dig into the numbers and see, hey, does it make more sense to use cash or use a policy? What questions are people asking? What should I be asking? I'd like to see numbers, all of that fun stuff. So if you did enjoy this video, please hit the like button, subscribe for more. Let us know if you have any questions or comments below. And as always, I hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.